If you're studying for the California Property and Casualty Broker Agent exam, this video is built for you. We're going to cover only what California does differently from the national rules you're learning elsewhere. So everything in your general study material about how a policy works, what a deductible is, how liability coverage pays out, we're going to assume you already have that covered. Our whole job here is the California layer on top of it, because that California layer is where most people lose points. The state portion is a large share of your exam, and it's the part general study guides treat as an afterthought. We're going to treat it as the main event. We'll move through how California regulates insurers and licenses you, how rates are controlled, the auto rules, the property rules, how claims must be handled, the safety net programs, and finally exactly what test day looks like. Let's get into it. California's insurance regulator is the California Department of Insurance, led by the Insurance Commissioner. Here's the first California-specific fact worth locking in. The Commissioner is elected by the voters, not appointed by the governor. Most states appoint that official, so if you studied national material, set that assumption aside. In California, the head of the department answers to the public directly, and that single fact shapes a lot of what follows. Now, the license itself. California uses a term you may not have seen in the national material, the broker agent. In most of the country, an agent represents the insurer and a broker represents the buyer, and they're treated as two different roles. California folds them into one license called the Fire and Casualty Broker Agent. When you hold that license, you can act as an agent, representing an insurer you've been appointed by, or act as a broker, representing the client shopping for coverage, and you can do both. The distinction still matters because it changes who you legally represent in a given transaction, and the exam tests whether you understand that the same licensed person can wear either hat. What pulls you under California's licensing law in the first place is transacting insurance. Transacting means soliciting, negotiating, or actually executing insurance business. And the moment you do any of that for California risks, you need a license. Picture this. Someone helps a friend compare quotes and fill out an application for a homeowner's policy and takes a small payment for the help. Have they transacted insurance without a license? Yes. Negotiating and soliciting coverage is transacting, and transacting without a license is exactly what the law prohibits. So lock in the takeaways from this section. The regulator is the California Department of Insurance. The commissioner is elected. The license is the Fire and Casualty Broker Agent, and it lets one person act as either agent or broker. In the next section, we'll look at how you actually earn and keep that license, including the education hours California requires that the national material won't tell you about. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Earning the license starts with education, and California sets specific hours. Before you can be licensed as a property and casualty broker agent, you complete 40 hours of general pre-licensing study plus a separate 12-hour course in ethics and the California Insurance Code. That 12-hour ethics and code course is a California signature requirement, so remember it as its own item, not part of the 40. Then you sit the exam, which is given by PSI, the testing vendor California uses, and you complete a fingerprint-based background check. Once you pass and your background check clears, you file your license application through the state's online systems. After you're licensed, the clock that really matters for the rest of your career is the renewal clock. California issues the license on a 2-year cycle, and to renew it, you complete 24 hours of continuing education every 2 years. Inside those 24 hours, 3 must be ethics. We'll say that again because the exam likes these numbers. 24 hours of continuing education every renewal term, including 3 hours of ethics. The ethics hours are part of the 24, not added on top. Here's a quick exam-style contrast to keep the numbers straight. Prelicensing education and continuing education are two different things at two different times. Prelicensing is the 40 hours plus the 12-hour ethics and code course you do before the exam. Continuing education is the 24 hours, including 3 ethics you do every 2 years after you're licensed. The exam will try to get you to swap those figures, so anchor each to its moment, 40 and 12 before, 24 and 3 after. On your exam, if a question asks how often you renew and how much continuing education you need, the answer is every 2 years and 24 hours, with 3 of those in ethics. Mix up the prelicensing and continuing education numbers, and you'll miss it. Next, we'll turn to how you must handle a client's money and the conduct rules that can cost you the license you just worked to earn. The single most important conduct rule in California is how you handle other people's money. When a client hands you premium, or when an insurer sends you a return premium owed back to a client, California law says you hold those funds in a fiduciary capacity. Fiduciary capacity means the money is not yours. You're holding it in trust for someone else. The plain consequence is strict. If you divert premium funds to your own use, California treats that as theft, and it's punished as theft. There's no softer category for it. So what must you actually do with premium you collect? You have 2 clean options. You either promptly remit it, meaning you pass it along to the insurer or the person entitled to it, keeping only your commission, or you keep it in a separate trust account at an insured bank kept apart from your own operating money. What you may not do is mix client premium into your personal or business checking account and treat it as working capital. That mixing, called commingling, is exactly what the trust account rule exists to prevent. Beyond the money, California prohibits a familiar list of unfair and deceptive practices, and the exam draws heavily from it. Misrepresentation means lying about a policy's terms or benefits. Twisting means using misrepresentation to convince someone to drop one policy and buy another. Rebating means offering a client something of value not stated in the policy, like kicking back part of your commission to induce the sale. And defamation, false statements about the financial condition of an insurer, is prohibited too. Here's a scenario. A producer tells a client a competing insurer is about to go broke, with no basis for it, to win the sale. Is that allowed? No. That's defamation of an insurer, and it sits right on the prohibited list. Let's recap what to memorize here. Premium is held in a fiduciary capacity. Divert it, and it's theft. Remit it or trust account it. Never commingle it. And know the prohibited practices by name: misrepresentation, twisting, rebating, defamation. In the next section, we'll see the rule that, more than any other, defines California insurance, how the state controls what insurers are allowed to charge. To understand California, you have to understand Proposition 103. It was a ballot measure California voters passed in 1988, and it rewired how insurance rates are regulated in this state. Before it, California let competition set prices with little pre-approval. Proposition 103 replaced that with a prior approval system, and prior approval is the phrase to burn into memory. Under prior approval, an insurer must file a proposed rate and get the commissioner's approval before it can use that rate. The insurer cannot raise your auto or homeowner's rate first and justify it later. Approval comes first. The rate comes second. Proposition 103 did several other things you should recognize. It made the insurance commissioner an elected office, which is why we flagged that back in Section 1. It required an initial rollback of rates when it passed, and it created a process where consumer groups can formally intervene in rate cases and challenge an insurer's filing. That intervener process is distinctly Californian, and it's part of why rate changes here move slowly compared with other states. Proposition 103 also reaches into how auto rates specifically must be built. California law requires that an auto insurer weigh certain rating factors the most, in a set order of importance. the driver's own safety record must be the most important factor. The number of miles the driver drives annually must be the second. The number of years of driving experience must be the third. Only after those may an insurer use other approved factors. Why does the law force that order? Because the whole purpose is to tie your premium to how you actually drive, rather than to things outside your control. Once you understand that purpose, the order is easy to reconstruct. Record first, miles second, experience third. On your exam, if you're asked what system California uses to regulate rates, the answer is prior approval, and the source is Proposition 103. If you're asked which auto rating factor must carry the most weight, the answer is the driver's safety record. Let's recap. Proposition 103, passed in 1988, prior approval before any rate is used, an elected commissioner, an intervenor process, and a mandatory order of auto rating factors led by driving record. Next, we apply this to the auto line itself, where California sets hard numbers you must know cold. Every state makes drivers prove they can pay for harm they cause, but California's specific numbers are what you'll be tested on. California requires minimum auto liability limits of 30-60-15. Let's translate that, because it must land by ear. $30,000 for bodily injury to any one person, $60,000 for total bodily injury when more than one person is hurt in the same accident, and $15,000 for property damage. We'll say the shorthand again, 30-60-15. The law also schedules these minimums to rise to 50-125 on January 1, 2035. So if a question references that future step, that's where it comes from. But the figure to carry today is 30-60-15. California is an at-fault state, sometimes called a tort state. That means the driver who causes the crash is the one responsible for the resulting injuries and damage. And there is no mandatory personal injury protection the way some no-fault states require. So if your national material drilled you on no-fault and PIP, set that aside for California. It isn't the system here. Two more California-specific points carry real exam weight. First, the good driver discount. California law guarantees that a qualifying good driver pays a rate at least 20% below what they'd otherwise be charged. And an insurer cannot refuse to sell a good driver policy to someone who qualifies. To qualify, a driver generally must have been licensed about 3 years and have a clean enough record, meaning no more than 1 point and no serious offense like a drunk driving conviction in the look-back period. Lock in that number, at least 20% off, not optional, the insurer must offer it. Second, uninsured and underinsured motorist coverage. California does not force you to buy it, but it does force the insurer to offer it, and you can reject it only in writing. Here's a scenario to tie it together. A driver with 3 clean years asks for a policy, and the insurer says it would rather not sell to them at the good driver rate. Allowed? No. If the driver meets the good driver criteria, the insurer must offer that policy at least 20% below the standard rate. Recap, the must-knows. 30-60-15 today, rising to 50-125 on January 1, 2035, at-fault state, no mandatory PIP, good driver discount at least 20%, and mandatory. Uninsured motorist coverage offered, rejected only in writing. Next, we'll cover what happens when a driver can't get insured in the normal market. California runs 2 programs for drivers the standard market won't easily serve, and both are favorite exam material because they're purely state-specific. The first is the California Automobile Assigned Risk Plan. Think of it as the market of last resort for auto. A driver who can't find a company willing to write them can be assigned to a participating insurer through the plan, so that nearly anyone who must be insured can be. There's even a rule that ties into the surplus market we'll cover later. Private passenger auto generally has to be run through the assigned risk plan before it can be placed with a non-admitted insurer. The second program is the one to study carefully, the California Low-Cost Automobile Insurance Program. The state created it so that lower-income good drivers can afford the liability coverage the law requires. Two things make it distinctive. First, its coverage limits are deliberately lower than the standard minimums. A basic low-cost policy provides $10,000 per person and $20,000 per accident for bodily injury and $3,000 for property damage. That's 1023, and here's the key point. The exam loves. Even though 1023 is below the standard 30-60-15, the law treats a low-cost policy as satisfying California's financial responsibility requirement. Second, you have to qualify. A driver must have a household income at or below 250% of the federal poverty level, own a vehicle worth $25,000 or less, be at least 16 years old, hold a valid California license, and have a good driving record. On your exam, watch for a trap that swaps the two programs. The assigned risk plan is about availability for hard-to-insure drivers. The low-cost program is about affordability for income-eligible good drivers. Let's recap. The assigned risk plan is the auto market of last resort. The low-cost program serves income-eligible good drivers, carries 1023 limits, still satisfies the law, and requires income at or below 250% of the federal poverty level and a vehicle worth $25,000 or less. Next, the rules for ending an auto policy. California sharply limits when a company can drop an auto policy, and the rules turn on a 60-day line. Once an auto policy has been in force for 60 days, the insurer can cancel it midterm only for specific reasons. Those reasons are non-payment of premium, a driver's license suspension or revocation among the people covered, fraud or serious misrepresentation in getting the policy or in a claim, or a substantial increase in the hazard insured against. The point of that 60-day rule is to stop insurers from writing a policy, taking the premium, and then dropping the driver on a whim once the contract is underway. The notice periods are the numbers to memorize. To cancel an auto policy, the insurer must give the named insured at least 20 days written notice before the cancellation takes effect. When the cancellation is for non-payment of premium, that notice shrinks to at least 10 days. Non-renewal is different from cancellation. Cancellation ends a policy during its term. Non-renewal simply declines to start a new term when the current one ends. For auto, the insurer must give at least 30 days written notice before the policy expires, if it intends not to renew. Let's anchor these by ear with a contrast. 20 days to cancel, 10 days if the reason is non-payment, 30 days to non-renew. Here's a scenario. A policy has been in force 4 months, and the insurer wants to drop the driver simply because it has decided to stop writing in that area. Can it cancel midterm? No. After 60 days, a desire to exit a neighborhood isn't one of the permitted cancellation reasons. The insurer would have to wait and non-renew at the end of the term with 30 days' notice. Recap: after 60 days, cancel only for the listed reasons. 20 days notice to cancel, 10 for non-payment, 30 to non-renew. Now we move from the car to the home. California protects homeowners with its own notice rules and disclosures, and these have grown stronger as wildfire risk has reshaped the market. Start with non-renewal of a residential property policy. The insurer must give the named insured at least 75 days written notice before the policy expires, if it intends not to renew. That 75-day figure is larger than the auto non-renewal notice of 30 days, and the exam likes to swap them, so hold them apart. 30 days for auto, 75 days for the home. As with auto, once a residential policy has been in force 60 days, the company can cancel midterm only for limited reasons, such as non-payment or a real increase in the risk. California also builds in disclosure. When you sell or renew a homeowner's policy, the consumer is entitled to a clear explanation of how their coverage is measured, including the difference between replacement cost, which pays to rebuild at today's prices, and actual cash value, which subtracts depreciation. The reason the state requires this is hard experience. After a major fire, families discovered their limits fell far short of the cost to rebuild. And the disclosure exists so buyers understand what they're actually carrying before disaster strikes. That hard experience produced the rule you most need to know here. After the governor declares a state of emergency for a wildfire, insurers may not cancel or refuse to renew residential property policies in the affected area for 1 full year from the declaration. We'll say that plainly: a 1-year moratorium on cancellation and non-renewal for homes inside or next to the fire perimeter. The purpose is to keep survivors and their neighbors from losing coverage at the worst possible moment. On your exam, if you're asked how long a homeowner is protected from non-renewal after a declared wildfire emergency, the answer is 1 year. Recap the numbers: 75 days notice to non-renew a home policy, midterm cancellation only for limited reasons after 60 days, a required replacement cost disclosure, and a 1-year post-disaster moratorium. Next, the programs that exist for when private property coverage simply isn't available. When the normal market won't write a property risk, California has a backstop called the FAIR Plan. FAIR stands for Fair Access to Insurance Requirements, and the plan is the property insurer of last resort. It exists so that a homeowner who has been turned down repeatedly, often because of wildfire exposure, can still buy basic fire coverage. 2 things to understand about it: it is a last resort, not a first choice, and its coverage is basic, centered on fire, and typically narrower than a full homeowner's policy. A buyer often pairs a FAIR Plan fire policy with a separate policy to fill the other gaps. Earthquake is its own world in California, and the rule here is one of the most tested in the whole state portion. A standard homeowner's policy does not cover earthquake. So California requires that every insurer offering residential property coverage must offer earthquake coverage to the homeowner. Read that carefully, because the exam hangs its trap right here. The insurer must offer earthquake coverage. It does not have to be the one that carries the risk, and the homeowner does not have to buy it. The duty is the offer, not the purchase. Most of that earthquake coverage is provided through the California Earthquake Authority, a publicly managed entity that participating insurers sell on behalf of. And the offer obligation has a rhythm worth memorizing. If the homeowner turns the offer down, the insurer must offer earthquake coverage again every other year. Here's a scenario. A homeowner declines earthquake coverage this year and hears nothing more about it. Has the insurer met its duty going forward? Only if it offers again on that every other year cycle. Silence forever is not allowed. Recap: the FAIR Plan is the property last resort for basic fire coverage. Earthquake is excluded from standard home policies. Insurers must offer earthquake coverage, usually through the Earthquake Authority. The buyer may decline, and the offer repeats every other year. Now, how claims themselves must be handled. California holds insurers to a strict timetable when handling claims, set out in the Fair Claims Settlement Practices Regulations, and these calendar day deadlines are pure exam gold. 3 numbers carry the section. First, after receiving notice of a claim, the insurer must acknowledge it within 15 calendar days and start the investigation. Second, after receiving proof of the claim, the insurer must accept or deny it within 40 calendar days. Third, once a claim is accepted, the insurer must pay the agreed amount within 30 calendar days. Say them as a rhythm: 15 to acknowledge, 40 to accept or deny, 30 to pay. There's a built-in pressure valve, and the exam tests it. What if the insurer needs longer than 40 days to decide? It doesn't get to go silent. It must notify the claimant in writing that it needs more time and explain why, and then keep updating the claimant in writing every 30 days while the claim stays open. The deadlines are calendar days, not business days, which is the kind of detail a tricky question will flip on you, so anchor the word calendar to each one. These time frames sit inside California's broader ban on unfair claims practices, which forbids things like misrepresenting policy provisions to a claimant, failing to investigate promptly, or lowballing a settlement the insurer knows is unfair. Here's a scenario. An insurer receives full proof of a covered loss and then simply stops responding for 2 months without a word. Has it violated the regulations? Yes, on more than one count. It blew past the 40-day decision deadline and failed to give the required written updates. On your exam, if you're asked how long an insurer has to accept or deny after proof of claim, the answer is 40 calendar days. Recap the three: 15 to acknowledge, 40 to accept or deny, 30 to pay, with written status updates every 30 days if more time is needed. Next, the market for risks no admitted company will touch. Some risks are too unusual or too large for the regular admitted market, and that's where surplus line insurance comes in. First, two definitions you must keep straight. An admitted insurer is licensed by California and backed by the state's safety net. A non-admitted insurer is not licensed here, though it may be perfectly legitimate elsewhere, and it's the kind of company surplus line business is placed with. Surplus line insurance is coverage placed with a non-admitted insurer because the admitted market won't write it. Because the buyer is going outside the protected market, California sets guardrails, and these are tested. Placing surplus line business requires a special surplus line broker license. Before going to a non-admitted insurer, the broker must perform a diligent search of the admitted market, and in practice that means documenting that at least 3 admitted insurers declined the risk. The state taxes these placements at a rate of 3% of the premium, and the customer must be told plainly in a written disclosure that their coverage is being placed with a non-admitted insurer that doesn't carry the same state protections. Here's where the trap usually hides. Because a non-admitted insurer is outside the system, its policyholders are not protected by California's Guarantee Association if that insurer fails. That's the single biggest practical consequence of going non-admitted, and it's exactly what we cover next. On your exam, if you're asked how many admitted market declinations support a surplus line placement, the answer is 3, and the tax to remember is 3%. Recap: admitted versus non-admitted, surplus line goes to non-admitted insurers, requires a surplus line broker license, a diligent search showing 3 declinations, a 3% premium tax, and a written warning to the buyer. Now, the safety net itself. When an admitted property and casualty insurer becomes insolvent, meaning it fails and can't pay its claims, California's safety net steps in. It's called the California Insurance Guarantee Association, or CIGA, and it pays certain covered claims of the failed insurer so policyholders aren't simply left with nothing. The detail to memorize is the cap. CIGA pays a covered claim up to $500,000 or the policy's limit if that's lower. We'll repeat the figure because it's a classic test number. $500,000 is the general ceiling on a covered claim. A few boundaries make this section exam-ready. There's a small deductible. CIGA covers claims above $100, so tiny claims fall outside it. Workers' compensation claims are treated differently and are not subject to that $500,000 cap. And here's the contrast that ties back to the last section. CIGA only backs admitted insurers. If a buyer's coverage was placed with a non-admitted surplus line insurer and that company fails, CIGA does not step in. That's the real cost of leaving the admitted market. One more boundary the exam likes. CIGA is the property and casualty safety net. Life insurance and health insurance failures are handled by a separate guarantee association, so don't reach for CIGA on a life insurance question. Here's a quick scenario. A homeowner's admitted insurer goes insolvent with a covered claim of $700,000. How much can CIGA pay on it? Up to $500,000 because that's the cap. Recap: CIGA backs admitted property and casualty insurers, pays covered claims above $100 up to $500,000, exempts workers' compensation from that cap, and does not cover non-admitted insurers or life and health. Next, a brief look at one casualty line California runs its own way. Your national material teaches the fundamentals of workers' compensation. So here, we'll touch only on what makes California distinct, because casualty questions can reach into this area. Workers' compensation is the system that pays an injured worker's medical bills and lost wages regardless of who was at fault. And in exchange, the worker generally gives up the right to sue the employer. That trade-off is called the exclusive remedy, and it's the concept to anchor. Benefits flow without proving fault, and the workers' compensation claim is normally the worker's sole path against the employer. What's distinctly Californian is the structure around rates and the breadth of the mandate. California requires essentially every employer with employees to carry workers' compensation coverage, with very narrow exceptions, and the consequences for going without it are severe. On the rating side, California relies on a dedicated rating organization that collects loss data and recommends advisory classifications and pure premium rates, which insurers then use as a starting point. You don't need to master the rate-making math for the state portion. You need to recognize that California has its own workers' compensation apparatus rather than simply following a national model. On your exam, the safest anchors here are the concepts: exclusive remedy, no-fault benefits, and a near-universal requirement that employers carry the coverage. Recap: workers' compensation pays without regard to fault. The exclusive remedy bars most lawsuits against the employer, and California mandates the coverage broadly with its own rating structure behind it. Finally, let's walk through exactly what test day looks like, because knowing the format is its own kind of preparation. Let's close the content with the test itself, because walking in, knowing the format, steadies your nerves. The Property and Casualty exam in California is administered by PSI. It contains 150 questions, and you're given 3 hours to complete it. The passing score is 60%. That 60% is worth a second mention, because it's lower than the 70% many other states use, and it surprises people. In California, 60% passes. The questions are multiple choice, and the exam blends general insurance knowledge with the California-specific material we've covered. So, the state layer you're learning here is woven right through the test. A few practical California details round this out. You can take the exam at a PSI test center or by online proctoring from home, and there's a convenience fee of $43 to test at a PSI site. There's also an examination fee paid when you schedule, and after you pass, a separate license application fee paid through the state's online licensing system. Treat the exact dollar amounts of those last two as the thing to confirm fresh before you register, because fees change more often than rules do. The exam is offered in additional languages, including Spanish for several license types, and you'll get a pass or fail result before you leave, with a score report to follow. On your exam, if you're asked the passing score, the answer is 60%, and if you're asked the format, it's 150 questions in 3 hours. Recap the logistics. PSI administers it, 150 questions, 3 hours, 60% to pass. Available at a test center or online, offered in Spanish among other languages. That's the full California picture. Let's lock in the numbers you cannot afford to mix up. Auto liability minimums are $30,6015, scheduled to rise to $5,125 in 2035. The good driver discount is at least 20%, and the insurer must offer it. The low-cost program runs 1023 and still satisfies the law. Claims run on 15 days to acknowledge, 40 to accept or deny, and 30 to pay. Auto notice is 20 days to cancel, 10 for non-payment, and 30 to non-renew, while a home policy gets 75 days to non-renew and a 1-year moratorium after a declared wildfire. Surplus line means 3 declinations and a 3% tax. CIGA caps a covered claim at $500,000. Continuing education is 24 hours every 2 years, 3 of them ethics. And the exam is 150 questions, 3 hours, 60% to pass. You've now got the California layer that the national material leaves out, and that layer is where this exam is won. Go through these numbers until you can say them without thinking, because on test day, fluency with them is the difference. You've got this. If this helped you study, give it a like and subscribe so it's easy to find when you come back to review, and good luck on your exam.